So what adjustments go into normalised profit?
Yeah, so normalised profit commonly was used as the number that gets times by the multiple to get to enterprise value. So it's an important number. Buyers will care about what they would call, I guess, sustainable profit. So that might be on an EBIT or an EBITDA basis, depending on how relevant depreciation and amortization is to the business. There's some companies where it's a really relevant charge. There's others where arguably it's not. Again, this is what an advisor should be thinking about in determining what thing within the P&L is applied to the multiple, balanced against what they can get data on. So that's the first thing. The first thing is picking the right profit metric. The second thing is then thinking about what drives sustainable, repetitive, let's say EBIT, for instance. There's often directors' remuneration to add back. And there might be also one-off costs as well in the current year or historical years, which have artificially lowered or increased the profit that would normally be expected to be part of what the buyer is experiencing once they've acquired the business. So really normalised profit is about finding all things being equal, this is what you should experience as a buyer. There's an art to it. There's an art to questioning it and finding out what should come where, and it's very. It can be a straightforward process, but there's normally a few quirks that people haven't identified. It's also
quirks, the ones that we regularly come across that cause a bit of a difficult discussion.
Yeah, I think directors' remuneration is often a big one. Sometimes there's questions around rent charges as well with the properties owned by the company, and there's a non-market rent being charged through intercompany transactions from closely connected businesses is another one. But sometimes there's dilapidations which have either been over or under funded through the P&L, and occasionally there's things that should have been capitalised onto the balance sheet that have actually been expensed, and that's quite important. So yeah, you put all of that together, and it's quite easy to get to material movement, which is then times by multiple, so it's always magnified. When you sell a business, it's typical to sell it on what's called a debt-free, cash-free basis. And what that means is the buyer is appraising not just your enterprise value, so the thing in the profit and loss account times by the multiple, but also your balance sheet as part of that. And balance sheets change over time. So what a buyer will do is look at debt and debt-like items and look at cash and cash-like items and adjust for it. And what that means is what they inherit is free of debt and free of cash. Now, that bit normally people understand. There's a debate about what is debt-like and what is cash-like, and that all goes into it, and that's an important part of negotiation.
Is that specific to every business? What is that?
Yeah, it's really specific to every business, and I think that's the thing that an advisor is meant to advise on. That's that's what they're meant to pick up and understand. And this for, let's say, some industries, construction, law, accountancy practices, professional services generally, they're businesses that suck up a lot of debt to capitalise them, initially. So the equity value to enterprise value adjustments for net debt can be quite significant. Can be really significant, actually. So that's one part. There's another part to this as well, which is called normalised working capital. So normalised working capital is where your current assets, which is typically debtors and stock, there might be a few other items as well, but not cash, and your trade creditors are weighed up against each other. And the idea is that when a buyer buys the business, there's a normal level of working capital left in the business. Now, if you're a growth company, so if you've got a fast growth, and you've sold a projection, which is, let's say profits growing really quickly, it's reasonable that a buyer would say, yes, but your balance sheet requirements are going to grow really quickly as well. And it would be unfair for me to buy your company and then have to inject cash to fund the next, say, 6 months worth of working capital. That's not right. So I expect when I buy this business, the value to be adjusted for normal working capital. So that's for a growth business, but also a seasonal business. You know, if you transact in high or low season, it is reasonable for a buyer to say, well, that disadvantages me, or the seller to say that disadvantages me. So the reason normalised working capital adjustments are used is to kind of make sure that in a seasonal business, there's, in theory, never a bad time to transact. And though you might want the high season to come so you can bank the kind of profit growth that was expected in your above budget, or to compensate for fast growth or fast decline businesses. And again, in a proper valuation report that looks at the value of the equity, not just the value, the kind of headline big number price. In a proper valuation report that's understood the value of the company, you should be working through net debt calculations and normalised working capital calculations.